Welcome to Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the three catalysts we're watching this hour. First up, we break down the market action and if the rally has legs as investors enter wait-and-see mode on trade. Plus, a floodgate of AI deals taking place during President Trump's visit to the Middle East. We'll break down the risks and rewards of those agreements. And retailers rush to restart production and shipments amid the 90-day tariff pause. We'll get the latest read on the industry later in the hour. Into the start of U.S. trading, let's get a check of the markets brought to you by Tasty Trade. Let's first of all take a look at the major averages, and we do see a very modest rally. We call it little change for the Dow and the S&P 500. The Dow just up 30 points here, not even a tenth of 1%. Ditto for the S&P 500. Tech leading as it has been, but just up about 0.25% today. So not seeing huge gains here, not any new dramatic headlines coming out of either the Mideast or more generally on trade, at least not yet. So not seeing much movement here. Taking a look also across other asset classes here and at the bond market, again, not seeing much movement there. Treasury yields very slightly down. And then want to take a look at the dollar and at gold. Now, gold prices have been coming off the boil because we had seen money pouring into gold on concerns about tariffs. Now that that has sort of abated, we have seen the gold trade come off a little bit. And I'm keeping a close watch on the dollar today. We're going to talk more about this later in the hour, but there is a report on Bloomberg this morning that maybe the dollar strength or weakness might be at play in some of these trade negotiations. That seems to be pushing the dollar down a bit this morning. But again, we're going to get to more on that later. First, I want to bring in my co-host for the hour, Thomas Hayes, Great Hill Capital Chairman and Managing Member. And Tom, obviously we've seen markets rebound and recover a lot of ground in a short period of time. The S&P 500 now a little bit positive on the year. What happens now?
Well, we have a lot of what we call trapped bears, okay? The data shows that in early April, you had $1.1 trillion of selling in U.S. equities. That was predominantly hedge funds and CTAs. So first you had the short covering rally after the tweet, the famous, it's a good time to buy stocks on April 9th. Now the market's up 15%. So they've covered their shorts. They're now chased and forced buyers. So I think as we continue to see more deals cross the tape, and there have been rumblings, more deals are on the way, you're going to have forced buyers. That said, from a trading standpoint, I think you move 15% in a few weeks. You probably consolidate a little bit, and a lot of people have jumped in Johnny-come-latelys. Sometimes you get a 3-4% pullback just to kind of shake the weak hands out before we move higher. But earnings are super strong. The earnings growth rate was twice what we expected for this quarter. We were expecting 6%. We got 13%. Estimates have held up even in the face of all of that uncertainty. Now that some of that uncertainty is removed, we could start to see guidance rip higher. And to your point on the dollar, that's going to help earnings in the back half. It's been weak.
I mean, some of the uncertainty. This sounds awfully bullish here, Tom. I mean, some of the uncertainty is removed, but we got 90 days. There's still 30% tariffs on Chinese goods coming in. There's still 10% tariffs on everything else. You know, these companies that came out and pulled their forecast, I don't hear them coming out and saying, actually, now we have a forecast for you. Right? So has the equation changed? I mean, how much has the equation for decision makers at corporations really changed?
Yeah, well, if we look at things were in their worst case a few weeks ago, and 2026 earnings still held up above $300 per share on the S&P 500, which is 18.5 times next year's earnings. The 10-year average is 18.3 times. So I would say the tariff news has only gotten better in the last few weeks. So if guidance was able to hold up in the worst case scenario, as companies start to report again in the following quarter, which they're not going to come out mid-quarter and say, hey, by the way, we did no guidance, now we're going to throw some guidance out. But they'll start to talk to analysts. Analysts will start to upgrade. You're seeing it now. All the people, you know, it's funny seeing these reports from different sell-side houses. One week they're saying recession chances high. The next week they're saying no recession, and they're just adapting to this. And companies now are going to come off the sidelines. They've been paused. They've just been saying, we're not doing anything. We're not making any investments for the last 4 or 6 weeks. Now you're going to see CEO confidence, CFO confidence. And by the way, what's so interesting, we had record buyback announcements year to date, $665 billion. So while hedge funds were selling in the hole, guess who was buying? corporations believe in the future. Even in the face of all that uncertainty, they were putting their money to work to buy shares in. This is going to be a positive thing prospectively.
The other thing I'm curious about is additional trade deals. None of them are actual deals, by the way. They're all framework. They're all plans to make a deal.
Yeah, well, here...
They're not details. All I'm asking is, are we going to get diminishing returns from these announcements going forward? I mean, China
Yes.
was really the big one.
China was the big one. Europe will be very, very important. But at the end of the day, here's the thing. If President Trump had come out and said, we're going to charge everyone 10%, okay? There's no way he would have ended up with 10%. So he came out, he threw a grenade in the room, he blew up the entire system. He said, we're going to tariff you 145%, we're going to tariff you 80%. Now 10% looks like the deal of the century, and it's an additional $300-400 billion into our coffers. So with that said...
That we're paying for!
Well... that's questionable because, you know, we had tariffs that were put into place in 2018, 2019.
That
and
was
you
a
actually
very
saw,
different place for inflation, though.
You saw disinflationary, so like washing machines, Whirlpool. The price went up like literally short term for a matter of months. 2 years later, the price per unit was actually lower. So there's something to be said. I think it's the perfect balance. You get a little rebalance. Look, China wants to move to a consumption-led economy by 2030. That is an explicit government mandate. They want to move to 70% consumption, just like the rest of the developed world. We want to increase our manufacturing percentage. We're already at that level of consumption. So this rebalance is natural and it makes sense. I'm very interested in what they're talking about as it relates to the currency, kind of lowering the value of the US dollar, because that also helps alleviate some of the imbalances. There were rumblings earlier in the year. Remember the Mar-a-Lago Accord, where they'd have a summit like they had in the mid 80s, where they devalued the US dollar. I don't know that that's going to be part of it per se, but I think that's the trend. We're going to get a counter trend bounce here in the dollar because everyone's bearish on the dollar now after everyone was bullish. And then we're probably going to continue lower, which is going to be great for S&P earnings, which is going to help rebalance the trade.
Gosh.
And we're going to be okay.
What could go wrong with you? You sound like everything is perfect, Tom.
Well, look, I look at businesses company by company. We did a client conference call April 7th, okay? And I went through every single company. I went through their balance sheet, their liquidity, their cash flow, their revenues, and all of these things were going up. The only thing that had changed is the headlines and the price relative to that. Yes, huge tariffs would have impacted the cash flow over
Okay,
time.
but you didn't answer. What's the big risk here? Is there a risk?
The big risk is you buy companies that don't have a large enough margin of safety. The tariff war has brought down so many companies 30, 40, 50% on the fears of the worst case scenario. Now that scenario's out. Positioning in cyclicals relative to defensives is at all-time lows. So it's got to be, what do you buy on the surface? The valuation of equal weight relative to cap weight is one standard deviation below the mean. Your money is going to be made finding those things that have been hit hardest by tariffs, worst case scenario. No longer worst case scenario. These things can double over the next 2, 3, 4 years.
Okay.
Yeah.
Tom Hayes, you're going to stick around.
All right.
We're going to do more
Sounds
of this. The House of Representatives is back in session this morning as lawmakers debate the GOP's tax bill. One major sticking point, the state and local tax deduction cap, SALT, as it's known. After failing to reach a deal last night, House Speaker Mike Johnson hoping to find an agreement today. Yahoo Finance Washington correspondent Ben Worschel has been tracking this closely. He's been readying his salty puns, and he brings them to us now. Hi, Ben. Good morning.
Morning, Julie. Yeah, so Mike Johnson, it's worth noting that Mike Johnson was talking about SALT yesterday, and he said he was hoping to have a deal by yesterday evening. That deadline is obviously switched into today, and it's kind of emblematic of how this SALT issue has emerged as one of the biggest sticking points in Trump's overall big, beautiful bill, which House Republicans are trying to at least get the bill into shape this week ahead of a vote in the House of Representatives next week. At issue here is Mike Johnson and his plan to triple the current SALT deduction. The current SALT deduction is $10,000 annually. This bill, as it's written now, would triple that to $30,000 for everyone making under $400,000 a year. There is a sort of GOP SALT caucus here. It's about 5 members, so it's very small, but they have rejected that out of hand. They're floating much bigger numbers, like a $62,000 credit, $62,000 deduction for individuals, and a whole lot of back and forth there. There was a closed door meeting meeting last night that saw sort of some members asked to leave and then critiquing those that remained, and then this kind of core salty five, as they describe themselves, sort of holding out for now. We're expected to hear more from Mike Johnson in the next hour, so we may have developments on this. The real deadline here is kind of end of the week, as what Johnson wants to do is have a final bill that he can then sort of put on the floor by next week. So expect a few more days of back and forth on this for certain.
Well, and is this sort of the biggest sticking point? Are there other things? And then the bill entirely, is that a realistic goal to sort of get that finalized version by the end of next week?
So this has definitely emerged as one of the key sticking points right now. There's a lot. This is a huge bill that's going on multiple fronts. There was two what's called here in Washington markups that went all night last night. The first side was on taxes. The second side was on Medicaid cuts. That's a real giant issue here. They're trying to find about $600 billion in Medicaid cuts to help offset some of these costs, and that's a big issue that's also going as part of this. So SALT is definitely not the only one, but it's a big piece of this. It's all sort of leading to this hopeful Memorial Day deadline for Johnson in the House. I will say that the Senate hasn't yet kind of weighed in, and they would revise this. The key deadline for everyone to watch here is this summer. So this is going to be a big process expected to be heading through July to kind of get this whole big, beautiful bill through the House, through the Senate, and to the president's desk.
Ben, thank you very much. Appreciate it.
Everything.
Tom Hayes of Great Hill Capital still with me here, because I want to get your take on this tax bill, right? Yeah. And the way that I've been sort of thinking about it is that if this didn't happen, it would be a big problem for the markets.
Yeah.
It happening doesn't seem to necessarily be a big catalyst because it's expected. Or what do you think would be in there that could move the needle more?
I think it will move the needle once it's done. It's going to be pushed through with reconciliation.
Just relief, like, yes, they got it done.
Relief, corporate tax rates, the impact on earnings power, the impact on the consumer having more money. But
they're not going to have more money than they do now, right?
Waitresses are. Look, no tax on tips. You got corporate tax rate. You've got. We're basically shifting now from the apocalypse into growth and deregulation. Growth and deregulation is the happy place, okay? So welcome to the happy place. We're now focused on growth. Companies can start to invest. The tax bill is one more cherry on the cake. And this is going to be the second half theme. So when Trump says stocks are going a lot higher, first off, his first tweet was right, okay, on April 9th. His second tweet last week when people were nervous before the UK deal was right. Yesterday, he's in Saudi Arabia saying stocks are going a lot higher. This is one of the few regions of the world right now that has an explicit growth program on the plate. Deregulation, tax cuts, billions upon billions, trillions of dollars investment in the United States incentivized for these businesses to go. That's going to create a huge amount of jobs. And if you remember Trump 1.0, guys who run money like me, we did okay. It was a good 4 years, a lot of volatility. We ended up fine, okay? Everyday people, middle class, working class people, if you look at the employment rate, real wages, they did better than ever. And I think you're going to see that cubed in this Trump 2.0. I think you're going to see the middle class, the upper middle class, the lower class, working class do exceptionally well. I think, by the way, it's interesting. I think you're going to see a continued outperformance of international stocks, even despite all of this growth programs. U.S. stocks are going to do great. International stocks are going to start to do well. It's a cycle that happens every 10 to 15 years. We started it in the first quarter of this year. So it's a balanced view.
Before the end of the show today, I'm going to get you to say something negative. That's my challenge of the deal. All your markets action straight ahead. Stay tuned. You're watching Catalyst.
Bitcoin's rally has resumed in recent days, nearing those old January all-time highs. So what is next for the cryptocurrency? Let's take a look at seasonality. I'm Jared Blickery, host of Stocks in Translation. Well, first, our seasonality definition here. This is a predictable and recurring change in data that tends to happen at the same time every year. And the emphasis is tends to. It's not a guarantee, and it counts for about 1/3 of price action if everything goes well. But 2/3 of the time, life can intervene, and we saw that this year in April when stocks which were supposed to be going up, they went down because of tariff realities. And the same was true for Bitcoin. So let's take a look at this Bitcoin seasonality map. And first, to back this up, I just want to show you, I'm using the 2018 to 2024 median and averages. Why not go all the way back to the beginning, 2010, 2011? That's because in the early days of crypto, and especially Bitcoin, things were a lot wilder, and this seasonality chart would just be off the charts. So I think this is a more realistic view because in late 2017, we got Bitcoin futures for the first time. This kind of marked the beginning of the institutionalization of cryptocurrencies, and so that's why I'm using 2018 to modern times. So back to the chart here. Let me just dig through what's going on. This white line is what has happened so far this year, and you can see we took a pretty big dip there, while seasonality would have said we're supposed to rally into early May throughout the late April. But we did still get a rally. It just went down to lower levels than we would have thought if seasonality had held. So there's no guarantee that seasonality is going to hold going forward, but let me just outline where these potential turning points might be, because we are at one right now. So right now we have a little bit of a headwind into mid-June, and then things tend to turn around into about mid-August. And then in late September, we get a nice rally according to history, and that lasts into about mid-November. Then we come down a little bit, and then maybe a little bit of a Santa Claus rally into the end of the year, raining tokens on everybody. But that's just the tendencies. So let me go to now a price chart of Bitcoin and show you what's actually been happening this year in a little bit more detail, because we have an interesting potential rounding bottom, and this could turn into a cup and handle. What happens is when price approaches a prior resistance level, and in this case, we're talking about the all-time highs from earlier this year in January, a lot of times things stall out, and you have people looking to get out because they were late buyers. They're finally back at break even, and so price stalls out. Then it comes down a little bit, and you get that handle, and then things tend to turn up, and you see that zigzag higher once again. That could be the case, and so I would be looking for a resumption of the rally, maybe in a little bit of over a month. Now, anything can intervene in the meantime. Trump could come out with new pro-crypto policies. That could shift the tides, and we could see a breakout here, but this is just the historical tendency. Also want to show you what has been happening in some of the other tokens, which got really depressed. Ethereum took a nasty 2/3 hit, cut more than in half this year. And you can see only recently did it finally break out of this trend line. But over the last month, it is up about 60%. And speaking of this time frame, in the last month, I'm going to put all of these individual tokens here and sort by performance, so you can see we have a lot of these outperforming, some of these smaller ones from Monero to Dogecoin to Solana, all of these participating in a nice rally over the last month. And what I've observed historically is that when you have broad participation in crypto, it speaks as to the strength of the entire group. So I think the potential for a crypto rally is in place. We just need some seasonality to align. And maybe in the coming weeks to a month, we'll finally see another turn up in price. Tune in to more Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Thanks, Jared. Now time for some of today's trending tickers. We're watching CBOE, Nubank, and Aurora. Let's get, first of all, 2 shares of CBOE. Global markets declining after Morgan Stanley double downgraded the stock. Analysts wrote that a greater than expected de-escalation between the U.S. and China limits upsides for options volumes here at the company. So double downgrade going to underweight from overweight here. And the analysts saying that the company had benefited from the volatility that we have seen surrounding the tariffs. Volatility, good for CBOE, good for options volumes. Tom Hayes still with me here. So interesting call here on the effect that more calm has in the markets, which for many investors is like, thank goodness. Yeah. But if your options, or if you rely on options for your business, maybe not as positive.
Yeah, when volatility ticks up, you buy CBOE. That's a no-brainer. Volatility, huge crush in the last 4 weeks. So their revenues are going to be a little bit lighter. Double downgrade, it's a little aggressive. It's such a great business. It's got kind of a monopoly in the space. So I think long term it's okay. I think short term I actually like the sell side call, which I don't say very often.
Oh, interesting. Okay. And then also we're looking at New Holdings. That's the holding company for Nubank. And watching that stock, it's a Brazilian digital lender here. It posted a slight miss in its adjusted profit for the first quarter. The company did see strong revenue growth of 40% year over year during the quarter, but higher spending on new clients dragged on its profit. The shares were down before. Now they've turned higher by a little more than 1%. It's among the most valuable lenders in Latin America. Warren Buffett's Berkshire Hathaway is among its shareholders. That's usually Tom's mood music when he hears that kind of thing. Yeah. We've talked to the company before, and it really has seen big growth. We also recently talked to Mercado Libre, another fintech and e-commerce company that's big in Latin America. And the theme that they emphasize over and over again is just adoption. Yeah. In other words, they're they're not as far along as we are here in the US with everyone on devices, shopping, banking online. And so there's a lot of upside.
Yeah, well, I got rich investing in South American banks is something no one's ever said. I will say this, look, they're growing customers, they've got a new technology, Buffett owns like a sliver, one of his underlings bought it. But as far as it goes, what you saw was their credit reserves went up in terms of expecting bad losses. And this is the same story over and over in Latin America. Brazil hasn't benefited from the international outperformance because of the political climate. So you really need to see a change in political regime. They're expanding into Colombia, that's weighing on costs. They're expanding into Mexico, so they have to invest a lot. This thing has been kind of dead money for years. Everyone said, well, Buffett bought it, it's going to be great. Well, Buffett didn't buy it, his underlings did. And it wouldn't surprise me if they do get the growth, if they get the momentum, if all the ingredients come together. But it's not there yet. So for me, it's a pass.
Okay. I mean, the stock hasn't, I don't know. I guess it has. It had a big run up. And now it hasn't.
That's why we're talking about it.
Yeah, I guess so. And let's talk about Uber offering $1 billion of exchangeable notes tied to shares of self-driving truck company Aurora. Aurora was one of the first autonomous vehicle startups to go public, a listing it achieved in 2021. Uber was the company's and is the company's largest shareholder. Couldn't sell its shares for 4 years. Aurora is a really interesting company. We actually had the chance to talk to the CEO recently. And to be clear, Aurora doesn't make the cars, the vehicles. It doesn't even make cars at all. Its software is for self-driving semi-trucks, and it actually is one of the first ones that actually has trucks using its software on the roads in Texas. So that was a big milestone for the company. Uber still owns over 300 million shares of it, 23% of the stock. But what you get is when you get a convertible offering, it can dilute the value for existing shareholders. But still, Aurora, kind of an intriguing, we keep talking about Tesla, Waymo, I mean, this company, its software is already driving out there.
I think this offering is just a way for Uber to raise $1 billion of cash without selling the stock. Right. And Aurora doesn't want them to dump $1 billion of stock on the market. So this is a great way. It converts at a 10 to 15% up into Aurora stock. So that means that stock, or into cash. So that means that stock would be pulled away from Uber. So this is, it's a way for them to monetize that position without destroying the market for Aurora and maintaining that partnership. So I think it's a smart move by Uber. I think Aurora likes it, and it's a bet that this could be the future because we do need truck drivers and we do need that logistics.
Are you invested in any kind of autonomous driving? Is that a theme that you're into? I know you're sort of more on the value side, so I don't know if this appeals to you.
I think the greatest international value in AI right now, and one of our largest positions, is called Alibaba. No one wants it.
Never heard of it.
Yeah, no one wants it. It's up. It's doubled off the lows. People are still not talking about it because the Republican Senate and House is saying we're going to delist it again. Every 2 years we're going to delist it. So we own it in Hong Kong. They're going to report earnings tomorrow. Okay, you saw JD. Earnings are going to be good. This is the cheapest way to own AI in the world because not only are their models beating DeepSeek and beating OpenAI, but they're the largest cloud provider. And what they say to all these AI startups in China, every single one of them, we'll help you out. We'll give you a free sample. We will give you cloud computing, which you need and you can't afford. You will give us equity. So Alibaba is effectively an AI ETF in China. They own a piece of all the AI startups. So that's the way I'm playing it. So indirectly, I probably have a lot of autonomous driving, but I have it through something with a huge margin of safety, $80 billion of cash on the balance sheet, generating $20 billion of free cash flow, buying in stock like there's no tomorrow, and a leader in AI. So, and by the way, they're the #1 retailer to the middle class. So as the Chinese push consumption,
a little bonus.
They're a toll taker.
That was a very adept pivot, Tom Hayes.
I try.
From autonomous driving to Alibaba. And the stock is up almost 60% over the last year, so not too shabby on that front either. Let's get to some breaking news that was crossing the wire. A wave of deals being announced amid President Trump's visit to the Middle East. This time it's Boeing. President Trump saying Boeing has won its largest ever order in the company's history. Qatar Airways said to have purchased 160 aircraft from the U.S. company. Again, Trump saying that this is the largest Boeing order in its history. Of course, there's some other plane headlines that the president made with a Qatari plane, but we'll leave that aside for the moment as that country gives him a plane. Tom, Boeing is a company you own.
Yeah,
it's a company you like.
This is a big one, okay? We owned it around $150. It dropped down to $129 with all the tariff barriers and everything else. We bought it like the lights were going out. I mean, because here's the thing, we bet on jockeys. So they call me Turnaround Tom. I like to buy great businesses when they're temporarily marked down. Kelly Ortberg ran Rockwell Collins, okay? Defense contractor, 7 years, 4-bagger for owners. He's actually an engineer on the floor. So it's nice to have Boeing run by a guy who actually goes on the floor and knows how planes are put together versus a salesman when the doors fall off mid-flight. That doesn't work, okay? So Kelly is going to turn the business around. He's already done that. The stock was 129 4 weeks ago. It's 200 today. They just got a huge order. This is icing on the cake. This guy can deliver. They'll sell some of the space business and at the margins, but they operate in a duopoly. It's like it was hysterical when the Chinese said, "We're not going to take your planes during the tariffs." China needs Boeing's plane like a diabetic needs insulin, okay? I mean, they can go to Airbus, and Airbus will say, "We're so happy to have you as a new client. Your wait is 21 years. How many would you like?" And so now, as soon as this was done, China went back to Boeing and said, "Can we get back in line?" And Boeing said, "Yeah, we'll open the door. We like you as a customer." So China's back in the game. Saudi Arabia's back in the game. And they're going to build the planes better than they've ever built them because Kelly Ortberg actually understands the business.
Okay, I hope that's so for all of our sakes who fly on Boeings. Tom Hayes is going to stick around with me, and we're going to have more on President Trump's deals from the Middle East coming up after the break on Catalysts. President Trump's visit to the Middle East unleashing a wave of AI deal-making, the Trump administration clearing a path for Saudi Arabia and the United Arab Emirates to pursue their artificial intelligence ambitions as deals with companies like NVIDIA offering Saudi Arabia and the UAE wider access to advanced AI chips, data centers, and AI infrastructure. What are the risks associated with those deals? Joining us for more, Mohammed Soliman, Senior Fellow at the Middle East Institute. Mohammed, thank you for being here. So I guess there's a lot of fanfare around all of these deals. It's not just about AI. We just heard about a big deal for Boeing planes from Qatar. So how are you viewing this sort of wave of deal making that we're hearing about?
Great to be with you. Let me start by saying that the relationship between the United States and the Gulf has changed in the past 10 years. It started gradually in the mid-2010s when the Gulf countries started to diversify their economies away from oil. And they believe and they think that their future of their countries as a sovereign states, as economies that's wired for the 21st century is all about AI infrastructure. So the Gulf countries are going to see that sort of trend of those Gulf countries, Saudi Arabia, UAE, and Qatar, trying to become the back end for compute power that fuels the AI ecosystems globally. And this means that they have access to low-cost energy, they have access to capital that they're able to invest in AI infrastructure. On top of all of that, they also secure partnerships with the United States when it comes to chips. So they have what I call the compute triangle: chips, data centers, and capital, and that what makes them a very powerful player in the AI ecosystem globally. And this is why you see a lot of excitement around the president's trip to the region, because it's more of a new era of a relationship between the United States and the Gulf wired around compute, not really crude.
And Mohammed, Tom Hayes is with me as a guest host for the hour, and he wants to ask you a question as well.
So Mohammed, what do you see as the magnitude of the amount of data centers relative to the rest of the world, and how are they cooling them? Is a key question in the Middle East moving forward. What do you see as the future? Is it going to be the data center hub of the world, or is it just going to be a major player alongside the U.S. and other nations?
Excellent question. I would say the United States and China, the Gulf is clearly emerging as this third theater of AI power. They are willing to invest heavily in AI infrastructure. And the question that you pose about cooling is extremely important. But I would say cooling today is not particularly about the question of access to water. It's about what cooling technologies that you have access to. We have seen a lot of new technologies, submersion cooling, directed chip cooling, that are reducing the cost broadly, the space needed for these sort of data centers. And I believe that the Gulf countries, through their energy companies, are investing in these sort of new chemicals for cooling, because this is an extremely important question for them. But to add on top of that, I think right now we're acting in an environment where energy is the real bottleneck for AI computing.
Yeah.
That I would argue that even ships with all the discussions around export controls and China able to access restricted AI ships from the United States, I don't believe that ships are the bottleneck. I think through cash, R&D, huge market, I think it's very fair to say that you're going to have other countries able to have that sort of capability. But I think the question of energy, abundant energy to fuel the AI ecosystem, is the main decisive factor here. And this is where the Gulf is finding its own niche.
So if that's true, then effectively the two winners by default have to be the Middle East and the United States, because we have effectively unlimited access to energy, and natural gas being the derivative play to see that in the first stages. Is that a fair way to think about it?
I think it's a very fair way to think about that. I think the Gulf countries have been investing heavily in building the electricity grids around this sort of major hyperscale AI infrastructure. I agree with you. The United States is clearly ahead in the AI race. We have more than 60% of the global AI compute inside the United States. We have the abundant energy. And with the new discourse trying to streamline permits inside the United States to do major data center buildup, I think we are going to hopefully maintain our lead.
Yeah, and moving forward, that puts China at a relative disadvantage.
I wouldn't say that yet, for a couple of reasons. China is a huge market, and they were able to prove that they're able to innovate and even exceed expectations when it comes to their own innovation ecosystem. We have seen the Huawei release of AI chip, the Ascend AI chip, and that has been doing actually better than expected. So I wouldn't really discount China. I think China is a competitor in the AI race. I think they have the determination, they have the R&D spending, they're willing to go the extra mile, and I think you're going to see a lot of breakthrough inside the Chinese AI ecosystem.
Mohammed, to come back to my original question about sort of the risks here, are there any national security concerns about some of these deals, sending chips, sending other infrastructure to these Gulf Coast nations?
This is an excellent question. And we do have two camps when it comes to the question of ships. You have the camp that says we have to restrict ships exportation to any part of the world. We only have to we should export ships to very trusted allies, Five Eyes partners, even NATO, even not the entire NATO nations were part of what we call the AI diffusion rule that was released under President Biden. So this is a camp. There's another camp that's saying that, well, okay, sure, we're going to restrict sending these ships overseas, but that comes at a cost. That means we're going to undermine our American companies when it comes to own profits. These are the profits that NVIDIA uses for R&D. So you have to come with a balance. And I think the discourse we're seeing right now is how to come up with a government-to-government AI agreement with the countries that matter in the AI race, like the Gulf countries, when we have agreement on access, on security protocols, and by this, we're able to protect our own IP and our own ships. I think this is the way we're thinking about the question of ships and export control right now.
Mohammed, thank you so much. Appreciate it.
Happy to be with you.
Another stock that we are watching, it's the best performing stock in the S&P 500 this year. Might be a little bit of a surprise. It's NRG Energy. It's up about 71% this year. It recently announced a $12 billion deal to acquire a fleet of natural gas-fired plants from LS for about $12 billion, as we said, including debt. Betting the fuel will be crucial to meet electricity demand from data centers. NRG is a Houston-based power producer. It's already been a key beneficiary of the AI-driven boom in the U.S. power system. Now it's vying to take a bigger share of that growth. So basically what we're seeing here is this big increase in NRG, this expansion. NRG already owns gas-fired generation. Right. It also owns solar and other types of renewable generation here. And the changing sort of Tom Hayes still with me, obviously. The changing face of what energy generation looks like in the United States has been really interesting as we've seen it powered by this data center boom.
Yeah, I think NRG is interesting. It's a great business. You've seen the stock go up quite a bit. But the problem is they rely on the kindness of strangers. They have to go to the regulators every year and beg them for price increases. That's the bad news. They've got to make all this investment in the face of not knowing what those price increases are going to be. However, they're gonna boom from this. They're gonna continue to boom, but the run is already priced in a lot of that good news.
Yes, but the difference with the rates is when they make those sort of they make the side deals with the data center operators, like we've seen to some extent. Right, Microsoft made the deal to reopen the reactor at 3 Mile Island, but so I think that's what they and investors are banking on.
I think so. I'd rather play the feedstock. I always try to play the arms dealers, not the warring factions. So for me, I'd rather play a natural gas company that have been left for dead, like Comstock Resources. Jerry Jones owns 71% of the stock. They've got the Haynesville Shale. And by the way, not only are you going to benefit from the unlimited demand from the data centers and from the utilities for that natural gas, but guess what the EU trade deals are going to all be about with the tariffs is all going to be, you take our natural gas, we will lower your tariffs. They're in the Haynesville Shale, which is right there where they can ship. So that's a good way to play. We started coming out on that aggressively at $8 and $9. It's $23. We think it can double again from here. Why is that? Well, they have to report to the SEC, all energy companies, PV10, proven reserve for 10 years. What they don't report is they've got 15 excess years of drilling that's not in the price of the stock, which is probably double plus from here. So we think this has a long runway driven by the AI theme. So when people say, what are your AI investments? I say, well, Alibaba is a derivative play. And I say, Comstock Resources. And people say, what do you mean? I said, natural gas. And that's the story. And NRG is going to be an equal beneficiary for sure.
Right. Interesting. Thanks, Tom. Appreciate it. Well, all your markets action straight ahead. Stay tuned. You're watching Catalysts. A temporary U.S.-China trade truce now in effect, with the U.S. lowering its tariff rate on China to 30% from 145%, China reducing its U.S. rate to 10% from 125%. This agreement stands for 90 days while the two nations work to finalize their trade deal. So what are retailers doing during this 90-day pause? They're shipping hand over fist. Here with more, Yahoo Finance senior reporter Brooke DePalma.
They're doing exactly that. They're jumping on this opportunity to ship at this lower tariff rate of 30%. And what experts are telling me is that this went from being an impossible situation to a much more manageable one as retailers can now take action. I want you to take a listen to what Bernstein analyst Anisha Sherman told us yesterday afternoon.
What we had seen leading up unto this announcement was that retailers and brands were stockpiling product in China and not loading it onto ships to come into the U.S. because the effective date of the tariff is the date in which the product boards the inbound vessel. So there were stockpiles of containers in China not boarding ships. With this announcement, we're now going to see the reverse, where we're going to see a surge of imports coming into the U.S. over the next month and a half, and probably even a pull forward of some of the holiday merchandise before that 90-day mark expires for fear of tariffs going back up.
So does that mean that companies now, the coast is clear? Everything's great?
Nah, absolutely not, especially for specialty retailers who have these larger exposure to China. And what we're hearing today from a brand like American Eagle is that this is certainly already impacting their first quarter results. They actually were supposed to report on May 29th. This morning, we got preliminary results from the specialty retailer. They withdrew their fiscal year 2025 guidance. They said that this macro uncertainty is hard for them to evaluate exactly how this upcoming year could play out. We also saw those preliminary results show that Q1 sales are expected to decline Revenue down 1.1 billion. They also said that comparable sales are expected to be down in the first quarter, down 3%. And they also had to do more promotions during the quarter. They had to do more, sales because of this excess inventory that they now have in stock because consumers pulled back. They were nervous about how this would all play out, this impact of tariffs.
Yeah. And if we're going to get more inventory, there's going to be more markdowns, which is disinflationary, along with gas, which means it could be true that Powell is too late. He's 150 basis points too restrictive. He's got to go in June.
Maybe.
Lots of unknowns.
I like how you made this about Powell.
But look, you got to look through 1 and 2 quarters. This is a short-term bottleneck. AEO is a random anecdote. I think.
Well, but it's not the only anecdote. There are a lot of other retailers where we're seeing similar.
We're seeing a huge divergence between hard data and soft data. Okay, so on balance, when we look at retail sales, consumers are saying the world is ending. They're depressed. Okay, but they're out spending like there's no tomorrow. If you look at the actual data, so you have an AEO. Could it be their mix was off? I'm saying on balance, I agree with what you're saying.
Could their merchandise not have been exactly what consumers wanted? And they even admitted that they got it a little bit wrong in this quarter.
Yeah, Lulu had the wrong color a couple quarters ago, and everyone said I can't wear yoga pants that are off green. I mean, I only wear purple yoga pants personally, but
Good to know.
You look at the market's a discounting mechanism. So it's a lot of these consumer discretionary stocks, when you look at the positioning relative to defensive, it's at record lows. This is known, right? So this is looking in the rearview mirror. When we look through the front window and we look at a better tariff climate, when we look at consumer confidence coming back, soft data to start to meet the hard data, I think you're going to see a boom, especially the wealth effect with the stock market back up is a very, very constructive thing for the consumer. They don't have to worry.
Look out for.
Yeah, so you'll be buying plenty of purple yoga pants.
That's right.
Brooke, thank you. Of course, you're going to stick around. We got much more coming up. You're watching Catalysts. The S&P 500 and NASDAQ have erased their year-to-date losses as investors flock to U.S. equities in the wake of a pause in steep tariffs between the U.S. and China. Our next guest is ETF flows into international stocks hit $7.4 billion. They're holding up even in the face of the U.S. rally. Let's bring in Julie Gunz, AllianceBernstein Global Head of ETF Strategy and Partnerships for this week's ETF report brought to you by Invesco QQQ. Thanks for being here, Julie.
Thanks for having me.
So we've talked a lot about the sort of balance between international and U.S., just generally in assets, but how has it played out through the lens of ETFs?
Sure. So there's been a lot of volatility over the past few weeks, and I think, April, even within, this week, we've seen inflows into international ETFs. And so, U.S. still dominates. U.S. large cap has been the biggest flows, but I think people are looking to international both from a valuation perspective and performance, and also to diversify their portfolios as, trade and tariff risk, has been muted for the time being, but I think we'll still be out there as the year progresses.
Yeah, it seems like international, you want two things in play. Number one is a weaker dollar, so that's helped. I think ex-US relative to the US is outperformance of some 15-16% year to date. So now this was a big theme for us coming into this year. How do you see that playing out in coming years? Because if you look at, zoom out and look at the long-term data, these run in normal 10 to 15-year cycles. And we've had this zero interest rate policy, so large cap tech has outperformed the last post-great financial crisis. That's over. We're in kind of a normalized interest rate environment. So do you see that as a favorable environment for the next handful of years for international relative to the U.S., or are you still king U.S. equities?
I mean, I think there's a place for both in portfolios. I think international, has the opportunity, especially with, if larger tariffs come into place, maybe there's more of a home bias in European countries or other places throughout the world. And so, clients and investors should probably diversify and have access to both, depending on how things play out.
I want to ask you about the active ETF landscape, which has been a big trend over the past few years. It's still a small little sliver of the overall ETF market, but it's been growing. Why are people so interested in it, and how big do you think that part is going to get?
Yeah, I mean, active ETF flows, we've seen 380 billion net flows into ETFs this year in the US, and active ETFs have been 40% of those flows. So only 10% of the market, but 40% of the money in motion. And I think the benefits are you take these traditional active investments that were in maybe mutual fund wrappers or different things, and you give them the benefits of the ETF. So, transparency, liquidity, intraday trading, and so you get the best of both worlds of active management and the ETF wrapper. And so I think that trend will continue, and we'll continue to see the growth in active ETFs.
Julie, thanks so much for coming in. Appreciate it.
Thanks.
Just want to get some final thoughts from Thomas on the U.S. dollar. And this after there was a story today that Bloomberg reported that the U.S. and South Korea in their discussions over trade had brought up currency as a possible lever. We did see the dollar pull back, particularly against the South Korean won on this. There's a lot of debate over whether a weaker U.S. dollar is a good thing or not.
It's going to help earnings in the back half of this year for sure. That's already happened. The dollar's been weakening. We're going to get a counter trend bounce because everyone's bearish on the dollar right now. However, the Chinese were pretty smart about this tariff negotiation because what they effectively did was they devalued the yuan by 20% ahead of talks. So it's like, okay, you want to do 20% tariffs? We're kind of flat. It's fine. So I think you're going to see a trend. There has been a theme earlier in the year. There were rumblings about the Mar-a-Lago Accord where they would devalue the dollar to balance out trade. I think you're going to see some pockets of this. I think the trend for the dollar moving forward is going to be a little bit lower in the coming years. That's going to help S&P earnings. That's going to help our trade rebalancing, and it's going to be a positive thing all around.
We'll see. Tom, thanks so much for being here. Appreciate it. That does it for Catalyst. Coming up, Brad Smith has you for the next hour on Wealth. Stay tuned.